The goal of this final chapter in our work on managerial accounting is to find ways to get accounting numbers to tell us stories about how our world would look depending on the short-term strategic decisions that we make. To make a strategic decision, we estimate all of the revenues or costs that are associated with doing something new and compare that to our current status so that we can see which option we like better. There are two ways to do this: incremental analysis and differential analysis. In incremental analysis, we compare the total costs or revenues between the two options. Whereas in differential analysis, we compare only the revenues or costs that will be different between the two options. If done correctly, either method should bring you to the right answer, but sometimes one method or the other is a little bit easier for particular kinds of problems. Before we look at specific short-term strategic decisions, we should talk a little bit about the kinds of costs or revenues that we should be paying attention to and the kind that we can safely ignore. Relevant costs are costs that we need to consider when making a short-term strategic decision. They're sometimes called differential costs because they differ between the two options. So, whatever choice we make is going to affect how much of this cost the firm will incur. Another term for these costs is avoidable costs. That is, a particular cost can be avoided by choosing one option, but will occur if we choose a different option. Another kind of relevant cost is opportunity costs. That is, what we give up in option A because we selected option B. For example, you're in a restaurant and you're trying to decide whether you want to have the chicken or the pasta for dinner. The opportunity cost of choosing chicken is that you have to give up the pasta, and the opportunity cost of choosing pasta is that you have to give up the chicken. So the idea of an opportunity cost is that you want to minimize it. In other words, you want to give up the choice that you would regret less. Some costs are irrelevant for a particular short-term strategic decision. That means that you don't need to consider these costs when making that choice. It doesn't mean that these costs aren't important in the great scheme of things. It just means that you don't need to factor them into this particular analysis. For example, unavoidable costs are costs that are going to occur no matter which choice you make. So, since that cost will be there no matter what, it shouldn't affect your decision. Another example is sunk costs, that is, costs that have already occurred. Since they already occurred, that means that nothing that you do in the present is going to affect them because they already happened. One of the reasons that managers sometimes have trouble making optimal decisions is that they tend to focus too much on sunk costs and not nearly enough on opportunity costs. For example, when you get to the restaurant, maybe you find that there's a long wait for an open table. And you think to yourself, oh, but we have to wait because of the time and the money that we spent getting here. Those are sunk costs. They're already spent, and no decision that you make now will bring them back. Instead, you might want to think about opportunity costs. Given the fact that I'm here now, is there some other place in the neighborhood where I might be able to get a good dinner without having a long wait? Another issue in strategic decisions is qualitative considerations. That is, issues that might affect your decision but aren't expressed in terms of money. One of our basic rules for managerial accounting is that numbers advise us, but they don't rule us. So, for example, you don't have to order the cheapest thing on the menu. You could, but there may be non-monetary issues that would make you choose something else. Here's a question to think about. When you're making a short-term strategic decision, should you use traditional absorption costing, or focus on total costs, or separate the variable costs from the fixed costs, or only focus on quantitative factors? That's right. You should separate the variable costs from the fixed costs. These costs don't behave in the same way. So you need to separate them so that you can determine which costs will be affected by the decision that you're about to make. Here's another question. Which of these costs would be irrelevant for a short-term strategic business decision? Avoidable costs, costs that differ between the two alternatives, sunk costs, or variable costs? That's right. Sunk costs can be ignored for a short-term decision. Since these costs already occurred, no choice that you make in the present can affect them. When making strategic decisions, should managers consider revenues or costs that differ between the two alternatives? Revenues or costs that do not differ between the two alternatives? All variable costs or all sunk costs? That's right. Managers should consider all of the revenues or costs that differ between the alternatives. When a firm is trying to decide the right selling price for its product, it needs to consider three factors. how much target profit it would like to make on each unit, how much customers might be willing to pay for each unit, and the firm's market position. Firms are price takers when their product is not unique. That means that they operate in a competitive industry. There are lots of other firms that provide similar products, so the market as a whole sets the selling price. If one price taker decides to charge more than the market price, customers will simply buy a similar unit from a different provider. If a price taker tries to sell for significantly less than the market price, then they're going to sacrifice profit on each unit that they sell. In that case, a price taker would use target costing. That means starting with the sales revenue, which is set by the market, and subtracting out the desired profit. That leaves the target cost, the maximum amount that the firm can spend to offer that product at the selling price set by the market and still achieve its desired profit. By contrast, price setters are firms that offer a product that is significantly different from the products offered by its competitors. Because of that, there's very little industry competition. Customers who want that particular thing would have to pay whatever the firm asks. Therefore, price setters use cost-plus pricing. That means starting with the full product cost, direct materials, direct labor, fixed and variable manufacturing overhead, and fixed and variable selling and administrative costs. Then they add the desired profit, and the result is their selling price. Here are some questions to think about. When pricing a product or service, should managers consider only period costs, only manufacturing costs, only variable costs, or all costs? Right. Managers need to consider all costs when they're setting their regular selling price. Otherwise, the firm might not be able to earn a profit. When firms are price setters, are their products and services priced using target costing, or do they tend to have lots of competitors, or do they tend to be commodities, or do they tend to be unique? Price setters make products and services that are unique in some way. Therefore, these firms have little competition, so they can set the price that they want. Sometimes a potential customer approaches a firm and asks for a special price. That always means a price that is lower than what the customer would have to pay to acquire the goods or services in the market. If the firm has excess capacity, if they are not fully busy making products for their regular customers, then there's no opportunity cost for a lost sale. In other words, the firm can fulfill the orders of its regular customers and also the order for the customer who wants the special price. In that case, the fixed costs are not differential. The firm doesn't have to buy more machinery in order to accommodate the special order. So, as long as the revenues at the special price at least cover the variable costs of fulfilling the order, then it makes economic sense for the firm to accept the order. But if the revenues are less than the variable costs, then the firm might want to reject the order at the special price because the price that's offered doesn't even cover the variable costs to make the units. On the other hand, if the firm does not have excess capacity, if its entire productive capacity is already being used to fill regular orders at the regular price, then there's an opportunity cost. The firm would have to give up the profit that it would have made on the regular orders in order to accommodate the special order. In that case, the revenue has to cover both the variable costs and what it is giving up in those regular sales in order to make accepting the order make sense. Of course, this analysis is subject to qualitative considerations. For example, the special order might be for a sympathetic cause, like a charity, so the firm might decide to accept the special price even if it doesn't cover the variable costs. Or the firm might feel that accepting the special order would give the firm free advertising in some way. Another qualitative consideration might be market segmentation. In other words, if the firm's regular full-price paying customers find out that somebody else got a bargain, they might want a bargain too. Let's look at an example of how to analyze a special pricing decision. Develop makes photographic prints, and we have some information about their regular selling price for the prints, the variable cost per print, the fixed costs per month, and its current sales volume. In addition, we're told that the firm has excess production capacity. Develop gets a request for 500 prints at a special price, that is, lower than the regular market price. Should the firm accept the order? If we want to do an incremental analysis for this decision, that means we need to look at all of the revenues and costs for the firm's current status and then compare that to the revenues and costs if the firm decides to accept the special order. Let's look at the firm's current status first. Without the special order, the firm would have sales revenue equal to the 5,000 prints that it regularly sells at the regular selling price, 50 cents per print. The variable costs would be the 5,000 regular prints at 20 cents per print. Sales revenue minus variable costs gives us the contribution margin. Subtract out the fixed costs to get the operating profit. Now let's look at the firm's status if it decides to accept the special order. It would still have the 5,000 prints at the regular price of 50 cents per print, but now it would have an additional revenue of 500 prints from the special order times the special price, 40 cents per print. Variable costs are not affected by giving a special price, so the firm would have 20 cents of variable costs for both the 5,000 regular prints and the 500 special prints. Sales revenue minus the variable costs gives the contribution margin. Subtract out the fixed costs, which are not affected by accepting the special order, to get the operating profit. When we compare the firm's operating profit without the special order to its profit with the special order, we can see that the special order increases the firm's operating profit by $100. So based on economic considerations alone, the firm should accept the special order. Although, before it does, it should think about whether there are any qualitative considerations that might affect this decision. A different way to analyze a special pricing decision is to use differential analysis. In this scenario, the firm only looks at things in its world that would be different if it accepted the order. In this case, the only difference in revenues is the 40-cent special price times the 500 special order units. And the only difference in its costs would be the 20-cent variable cost per print times the 500 special prints, for a differential profit of $100. So, based on economic considerations, the firm should accept the special order. But before it does, it should consider whether there are any qualitative factors that might affect this decision. In this special pricing decision, the incremental analysis and the differential analysis both gave the same answer. The differential analysis is a little bit quicker because it leaves out all of the factors that will be the same regardless of whether the firm accepts the special order, and focuses only on the things that would be different. Which of these costs would be relevant to a firm's decision about whether to accept a special order from a customer in China? That's right. The cost of shipping the order to China is relevant for this decision because that cost will only exist if the firm decides to accept the order. The cost of the warehouse, the CEO's salary, the firm's investment in its websites are irrelevant to the decision because those costs will exist regardless of whether the firm accepts the special order. In the next section, we'll talk about some more short-term strategic business decisions.